Okay, a warm welcome everybody. Today we're going to be talking about the London opening range breakout strategy. My name is Dan Blystone, and this webinar is hosted by Scandinavian Capital Markets, where it's about the trader, not about the trade. So without further ado, let's jump right into the presentation. First of all, let's take a look at the topics that we're going to be covering today. We're going to be looking at the origins of the London opening breakout trade, or strategy you might call it. We're going to look at some trading legends who've traded breakout strategies. We're going to look at why the London session is such an interesting time to trade a breakout strategy. We're going to cover the exact strategy rules. And within that, we're going to look at some ways to optimize the strategy using trend following concepts. And finally, we're going to look at using ATR, that's average true range, to get a good idea for an intelligent profit target. So we're going to look at the ATR to look at what the range has been over the past 20 periods to get a kind of a sensible profit target for the strategy. So as I usually like to do, let's take a look at a couple of inspiring quotes before we get started that are related to the subject matter today. Got another one from Jesse Livermore. The desire for constant action, irrespective of underlying conditions, is responsible for many losses in Wall Street. So I think what he's saying here is that you don't want to go into the markets guns blazing, just taking any trade you want on impulse. You're going to be better off with a careful trading strategy instead of trading impulsively and over trading, and constantly trading irrespective of the underlying conditions is not a great way to operate. The next quote's from Linda Raschke, who is, if you're familiar with the Market Wizards books, Jack Schwager books, she's a market wizard. This one says, all you need is one pattern to make a living. So this kind of relates to what we're talking about today too, because it's a very simple system. This is a strategy that gives you just one trade a day, or maybe not even one trade a day, depending on how strictly you trade the strategy. And I think this is a very, powerful, wise concept that you should kind of just focus in on one thing and get that right, really have one pattern that you can rely on and then build it from there, rather than trying so many different things. Focus on just one thing that works, and hopefully we'll be giving you something in this presentation that you'll be able to use in that way. So now we're moving on. We're going to talk about some trading legends that have used breakout strategies. We talk about a guy called Toby Crabel, who's not that famous outside of the trading industry, but he's got a remarkable story and a remarkable track record. Used to be a professional tennis player for a few years, and he popularized somewhat the opening range breakout strategy. He's a technical trader. He's gone on to found and be the chairman of a firm called Crabel Capital Management, billions of dollars of assets under management. Nowadays, he specializes in systematic automated trading of futures and currencies. But this is a guy that is an example of a wildly successful trader who got started using technical strategies. So you hear a lot of people trashing technical analysis and doubting technical analysis and technical strategies, but here's a guy who's really succeeded using strategies like an opening range breakout strategy. There's a famous quote from Jim Rogers, the ex-partner of George Soros, where he says something along the lines of, "I've never met a rich technician unless," and then he kind of has a twinkle in his eye, unless it's a guy that's selling his services. And he's kind of got a bit of a point, because there are a lot of failed technical traders. It's very hard, and but Toby Crabel, I wanted to bring him up because this is a guy that was wildly successful and used technical strategies, including a strategy very close to what we're going to be talking about today. Another trading legend who used breakout strategies was Richard Dennis. At the time, one of the most successful traders in the world, famous for his experiment called the Turtle Traders, where he and his partner trained a bunch of novices with their trading strategy. That's a subject for a whole other presentation, but to basically just to give you the gist of it, they were able to successfully teach these novice traders to trade profitably using their trading strategy. And the strategy that they used was a trend following breakout strategy. And it was a very long-term breakout strategy. So they were using a 20-day high. They were looking for breakouts of a 20-day high, to buy on a 20-day high and to sell on a 20-day low. So Curtis Faith, one of the Turtles, was kind of joking around in an interview saying that they spent a lot of time playing ping pong and stuff because they got so few trades with this. But when they did get trades and the trades were successful, they were very, very, they were big winners. So this was the strategy that Richard Dennis used in his own trading. So those are a couple of examples of trading legends who have used breakout strategies. Specifically, we're going to be talking about breakout strategies during the London Open. And now why do we want to talk about the London Open? Why is that particularly interesting? Well, there's several reasons for that. Firstly, liquidity. About 30% of all FX transactions take place during the London session. Secondly, you've got tremendous volatility, normally the most volatile session out of all the FX sessions. And thirdly, and maybe most interestingly, is that you very often see trends beginning at the open of the London session that continue throughout the day into New York, and even until the beginning of the New York session, then into the New York session sometimes. So these are great trends to hop on early if you can. So this is a really interesting time to trade a breakout strategy. So now let's take a look. We're taking a look at the cable chart. That's the British pound against the US dollar. And the time frame that we want to look at for our entries is the hourly chart. So we're looking at the H1 chart. And so basically the way this strategy works is you look for the range that has developed during the Asian session prior to the London Open, and you're basically looking for price to move above or below that range. So here there was a kind of a textbook example of a successful trade using this strategy back on September 5th, about 10 days ago now. And so we can see what happened here. We've got the 8 o'clock candle is where the circle is. Prior to that, you have the range in which price traded during the Asian session. And we can see in this instance that price broke out to the upside and ended up rallying about 100 pips. You can see there's a moving average on the chart. We put that moving average up on the chart as a filter, so to kind of keep you trading in the direction of the overriding trend. So there's a rule in the system that says only take long trades when you're trading above the 50-period simple moving average, and only take short trades when you're trading below it. So in this case, we were trading above it, and it was a long trade. It was breakout to the upside, so we took that trade. If it had been to the downside, we wouldn't have taken it, because price has to be below the 50-period moving average in order to be trading in line with the trend, as it were. So let's get in and take a look more closely at the strategy rules. So to begin with, we're looking at cable, British pound against the US dollar. We're looking at the hourly chart for our entries. The London Open takes place at 8 a.m. London time. So we want to use the highs and the lows of the previous hourly candles to create the range. Some people use, 6 candles, 6-hour range. Some people go as far as 8 or more. I think you should use your discretion a little bit on how many candles to use to create the range. So again, I pulled up the chart again, and so looking back, we can see the range from the Asian session. We can see the breakout to the upside. It so happened that the breakout happened at the 8 a.m. London, at the 8 a.m. hourly candle in this instance, and price broke out nicely to the upside with a 100 pip rally. Moving on to the next slide. So to be really specific about the entry rules, you want to enter long or enter with have a buy entry, in other words. So you enter with a buy stop order placed 2 pips above the high of the range, only when price is above the 50-period simple moving average. And then conversely, you enter short with a sell stop order, placed 2 pips below the low of the range, and only when price is below the 50-period moving average. If you're not clear on what a buy stop and a sell stop order is, feel free to contact me and I'll be happy to walk you through that. So again, back to the chart. So the entry would be made by placing that buy stop above the high of the range. In this case, it would have been triggered as soon as price traded above the range, and then you would have been long and caught that up move. And then in terms of your stop losses, your protective stop losses, this is the same logic as you see in a lot of different trading strategies. So you want to place your protective stops 2 pips below the low of the range when you're long, and 2 pips above the high of the range when you're short. I think this is a sensible addition to the strategy. If price moves in your favor after the first hourly candle, cancel your initial stop loss and then just move to using a trailing stop. So again, let's take a look at the chart. And so, let's pull my mouse up here. So your stop in this instance, initially your stop would be below the low of the range. So again, you enter with a buy stop order here, above the high of the range, a couple of pips above the high will have been triggered when price moves up there. And you would have wanted to put your protective sell stop below here, below the low of the range. And then in the following candles, you can move to a trailing stop, so your stop's not so far away anymore. Next up, let's look at this twist of the strategy using average true range. Average true range is an indicator that was developed by Wells Wilder. You've probably heard of him. He's really done so many things in technical analysis. He's also the creator of RSI and a bunch of other indicators. But basically, ATR just measures volatility, or you could call it true range, and it's displayed using a moving average. So it's an average of the true range of the market. And when you're using this indicator, you select, like other indicators, the number of periods that you want to use, that you want to observe, basically. And in this instance, we're going to use the typical setting, which is 20 periods. And in order to calculate this, we swap over from the hourly chart. We're going to zoom out and look at the daily chart. So now we have our strategy up on the daily chart. We can see September 5th where the trade took place, and we can see the average true range down here. So we want to look at what the average true range was at the time that the trade took place. And what the average true range was telling us for the prior 20 periods, you can see it's a 20 period ATR, is that the average range was roughly 100 pips. So in this instance, the average true range was just right for a profit target because price rallied about 100 pips when it broke out of that range from the Asian session. So basically, the average true range is it's a moving average, so it's constantly changing based on the range each day. But when this trade took place, there was a pretty decent average daily range to work with. So to have a 100 pip profit target was actually reasonable in this case. If price had been trading in a really tight range, you would have had a lower ATR, and it would have been sensible to have a smaller profit target. So that's it. It's just about looking at how volatile the market is in terms of what your expectations can be for how far the market's going to run when you do have a trade going in your favor. So that's a useful additional tool there. So again, This indicator is useful for the London opening range breakout strategy because it helps identify an appropriate profit target based on the volatility of cable, British pound against the US dollar, over the past 20 days. We can see that it has changed significantly. It's been getting higher and higher here. Recently, the volatility has risen. And so that leads us to the conclusion of today's session. So the points that I want to emphasize is the strategy helps you get into trends early and make the most of the volatility, the liquidity of the London session. It's an intraday system with a maximum of 1 trade per day. For example, if that long trade that we looked at, it occurred below the 50-period moving average, we wouldn't have taken it because we wouldn't have been trading in line with the overriding trend. So you might not even get 1 trade a day, but when you do get a trade, it's a fairly high probability setup. Intraday system with a maximum of 1 trade per day, and it's relatively low maintenance because it's kind of a set and forget strategy. You get filled, you put your stop in, you can put in a trailing stop, and then you just let it go. It's pretty low maintenance strategy. And finally, it makes a good introduction to rule-based trading strategies. So it's a good way of getting into a disciplined style of trading where you're trading purely based on a set of rules. So with that, guys, I want to wrap it up. I want to thank you very much for joining today. If you've got any questions, you can email me at dan@traderslog.com, and I look forward to seeing you again at the next session. Have a great week. Bye.